Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Thank you for joining us for market insights and observations. Today is August 10th of 2023, and we actually got an important inflationary read report today. We'll talk about that, the historical playbook, what does history show, and how do we position accordingly, and then what to watch moving forward. So thank you for watching. But getting right into it, the U.S. core CPI improved for the second month in a row at 0.2% positive in terms of growth rate, but it's a slower rate of growth month over month. This is for July specifically. And here are the key highlights. The U.S. CPI, 0.2%, which is a 3.2% year-over-year growth rate on the CPI, or the core, which is ex food and energy, again, was up 0.2% for July, which is both expected. But the U.S. labor market does not appear to show signs of slowing down or even rolling over, if you will. There's some moderate concerns there, some cracks here and there, but nothing to put the Federal Reserve in sort of a clear guide path or playbook, if you will, for them to actually pause or even start cutting. Cutting is maybe way into the future, 2024. Pausing is the next question in September, October here. But we again got inflationary data that is moderating and trending in the right direction, I guess, in the last 2 months. And we'll talk about that. But the bottom line is there's no more data to come. That's basically going to put the Fed ultimately on pause for September. So there's still potentially an opportunity for the Federal Reserve to make a move. And since inflation historically comes in multiple waves, this is the most important thing. In fact, we're going to talk about in the historical playbook today of the research that we've done, that we've uncovered. One of the things is that the Federal Reserve does not want to repeat what it did late 70s, early 80s, where it was the increasing interest rates and then stopping and then reducing interest rates, and then inflation then would resurge ahead. Several waves in that time frame, historically speaking. That's what made the prime interest rate 21.5%, and Federal Reserve Chairman Paul Volcker had to come in and break the back of inflation, but it wasn't without pain to the U.S. consumer all across the board. So the Federal Reserve, we believe in our estimation, is going to have to go higher for longer and stay right where they are, if not potentially another rate increase. Why is that? Because U.S. inflation historically starts on average 30 months after its peak. So we're only in month 13. So keep in mind, in the past of June 2022, the peak for the CPI was 9% year over year. So we've already come down from 9% down to 3.2%. So we've made some considerable progress. Again, the Fed's target is 2%. So we still have to trend that way. But what this is saying, historically speaking, is there's always another wave that actually hits, sort of a boomerang effect of inflation. Scary to think about. So we have to anchor inflation right where it is, and we'll talk about the U.S. core inflation month over month. Here are the last 2 months, actually making some progress on a downward trajectory, which is positive. Inflation trends tend to come in multiple waves. Historically, this is what we talked about. So this is going back to the 1910s, the 40s, and the 70s, and this is the first peak to trough, and they're showing that there's another peak to trough. If you layer sort of those timelines of how history repeats itself historically with regards to how inflation has played out in the past. Doesn't mean it will, but this is a pretty good playbook, if you will. There can be multiple and further waves of inflation after the first peak. Here's our first peak, okay? The concern right here is, does this re-accelerate to another peak? This is the ultimate question mark in everybody's mind, and this is what the Federal Reserve doesn't sleep well at night with regards to this. So this is where we are. We have to keep it where it is and keep trending down. Now, the U.S. housing market, there's 2 key components that we're going to pay attention to. Housing market, now keep in mind, housing is trending down price-wise, yes. Rents, not so much, but they are in the right direction at this moment in time. Those are anchoring effects of inflation. Those keep inflation higher because of those higher costs. They're going to have to stay higher because the mortgage rate is 7%. Rents will rise because of that, just basically the cost of living. This is where we get that boomerang effect of Federal Reserve raise interest rates significantly over the last 36 months or 20 plus months right now, and now you're seeing all of the costs of being passed on to the consumer. That's where you get your 30-month lag to higher inflation. Housing is one of those. And also keep in mind, housing is in a short supply, even though historically, okay, well, we've seen the prices of homes go up so significantly. They'll come down a little bit, but there's always going to be that buy-in, if you will. The next generation, there's a younger generation that now is basically moving from the urban cities because they can work anywhere, and they can now start buying homes. Well, we don't have enough homes to support this, from a long-term standpoint. But this is our core CPI. We already talked about that. It's trending in the right direction. This is what I was talking about, the U.S. housing CPI rents. If we look at the Zillow rent index year over year, as well as the CPI rent is up here, but the Zillow rent index is showing us that there is significant movement to the downtrend. So both of these should converge in the same direction, on the same trajectory. This is down, but there could be a bottoming out phase at some point in time in the future. And the key is, does it go spike back up or does it moderate back up? That would be what we would want. Still watching slow moving components. This is the rent we're talking about. We're also talking about owner's equivalent rent, and then the shelter costs are still sort of trending up, if you will. And now, core is still way too high year over year, and we were talking about this housing, and this report came up, well over, 0.35%, and that's what the contribution was year over year. If we just look at housing, it's up 6% in terms of inflation, and that's how it. Food is up, goods and services, food, recreation. We know that's up, and then everything else that's down: apparel, education, communication, medical care, and then transportation. Those are down. Transportation is down because energy's down. So energy's now creeping back up. If you watch oil, that's one of our, we were on Fox Business talking about energy is one of our sort of core convictions for the second half of this year in terms of an asset allocation, reallocation towards. Again, all eyes on inflation and the CPI. Why the Fed cuts are tough right now? Because they don't want to do the stop and go mistake of the 70s. This is what we talked about earlier. Stagflation in the 70s ultimately is where basically, U.S. unemployment rate keeps peaking higher and higher and higher, and a number eventually was a squash in the early 80s. But it's essentially where your wages don't keep up with everything else going up around you, and that's where we could see that rebound effect of inflation. But wages in the U.S., we're starting to see that roll over a little bit. That's easy for me to draw. And we'll see if it normalizes. All we want to see, we don't want to see anybody not be able to afford, but we have to have housing come down. We have to have interest rates come down, mortgage rates come down. But the Federal Reserve, again, is going to hold it higher for longer. And that's where the catch is right there. That's where the real acceleration could happen, almost inevitably, potentially. This is, again, why, tomorrow we have another media sort of conversation, and we're going to reiterate. I had a Bloomberg yesterday, and Bloomberg was a conversation about we could see the 10-year Treasury well above, once it goes to the corrective phase right now, sort of taking a breather because it hit 409, which is sort of a ceiling. It's going to break through. And basically be a new base case potentially. Check out that 409 to about 493 range, or the 5% in the 10-year Treasury. This could be the second sort of next fear or leg up for equity or for fixed income. Now, how do we position that, Rob? What do we do? What's the playbook? What are we thinking about? This is where we're going to extend out on the yield curve. We're waiting for this. We stacked our treasuries to be 6-month, 9-month, 12-month. They're all rolling over now in terms of maturing on our T-bills. So we got a good 4.5% yield on that. Now we're looking at 5.5% in some cases, especially in the 2-year. But we could even go wait until, again, another shorter duration, let that mature. And then once the 10-year actually hits, even higher, lock in, go longer on the duration yield curve, lock that in for longer on our side. And that's a win, because ultimately, let's say 2024, 2025, the trajectory of interest rates will have to come down at some point in time. Therefore, we've locked in, 5 to 6% handle on some of these, fixed income. That's not a bad rate of return, if you will. So that's where we see it. That's the historical playbook, what the Fed has to worry about, what we're paying attention to, what you should be watching, and why that matters to you and your portfolio. But we're here. If you have any doing reviews, questions, comments. We're doing a real estate review for some clients today, sort of off the mark outside of what we do on our purview on a daily basis, where we're paying attention to the real assets here, but we also look at the total balance sheet in life. So if there's things happening, our kids are going to college. I'm happy to have that conversation because my kids are going to college right now too. So there's a lot of basic finance, that financial things they need to know about, from credit cards to debit cards to PIN numbers to even just basic checkbook 101. So that's our update for today. We're here for you. Thanks for watching, and see you again next time.